Welcome to the Ellsworth Advisors monthly update for April 2025. I'm Kelly Keenan. This is Cameron Mealy. Today we'll talk about the how the markets performed in April, the latest economic data, and really how our portfolios performed, and then also what we expect the next several months or so. Cameron, let's kick it off with the latest economic data.
Thank you, Kelly. Hope everybody is well out there. As referenced, today is May 5th. Let's talk first and foremost about GDP, because I think that's going to frame a lot of the discussion. On April 30th, the Bureau of Economic Analysis reported that according to its advanced estimate, GDP in the first quarter decreased at an annualized rate of 0.3%. This is the first decline in quarterly GDP since the first quarter of 2022. Primary cause was an import surge. We talked about this last meeting. If you look at the numbers on first quarter GDP, approximately 4% to the downside of first quarter GDP was the result of imports. And really what that means is because of the threat of tariffs and goods coming in costing more, a lot of people front-loaded their purchases. Imports are a drag on GDP, so that can artificially create a negative or a lower first quarter, and then those goods are pushed out of the system. That'll be a positive to GDP. So the number is shocking in terms of a negative number, but when you dive into things, it's not as significant or severe as it looks. It's a little bit of a manipulation of the numbers, but that GDP really is going to, it really frames the discussion of the overall economy. There is a lot of thought. A lot of the numbers do suggest that the U.S. economy is slowing. And so what that really is going to drive is we have not had a Fed meeting in a while.
Well, let's back up on the GDP because there's a lot of nuance in there. The big part being the negative drag because of imports. Part of that import number is gold. So a lot of gold was bought, physical gold. So that is an import, not necessarily being put into inventory to be sold. So once again, that skews the numbers even more. I did see one report over the weekend that factoring out some of the distortions because of this pull forward, factoring out their number, okay, they came up closer to like a 2.3% annualized GDP, which going into the year pre-tariffs and all the chaos that's been going on, kind of is in line.
So that's a normal first quarter.
Well, it's a normal first quarter, but what you were about to lead into is it does show some weakening.
Yes.
And that's the big thing is, okay, we're kind of on a weakening path, which makes sense. We've had higher interest rates. The Fed's kept lower, short-term rates higher. So it is slowing the economy, going into recessionary type numbers, which, a negative 0.3% GDP is technically the beginning of a recession. But then again, looking deeper into the numbers, maybe it's not really a recession, but we are seeing slowing in the economy.
We're definitely seeing slowing. So that really, it begs the question of, are we getting geared up now for a Fed interest rate cut? President Trump has been he's been demanding for an interest rate cut. The Fed did not meet in April. Their current meetings are scheduled for this Monday and Tuesday, May 6th and 7th. The current Fed funds rate, the target rate is 4.25 to 4.5. So the real question is between softening inflation, which we'll get into, the negative GDP, employment picture looking a little bit more cloudy. Are we setting ourselves up for potentially a 25 basis point Fed rate cut on Wednesday?
Well, I think the Fed is, they wanted to see what the effects of this all were.
Real way too early.
Yeah, the
real and everything to really know what.
Yeah, the real in the weeds inflation numbers have been kind of showing that maybe inflation is coming down, maybe it's getting under control. And, you talk about the inflation numbers we're going to talk about right now. Those are going to be okay. Hey, we are seeing, looks like prices are getting a little bit under control here. And will the Fed want to see it maybe another month or so? Possibly. But I think they're closer to moving on rates than further.
Yep, I agree with you. So let's look at some of the numbers and where we're getting these inflation figures and employment figures from. Be quick about this. The Personal Consumption Expenditure Index on April 30th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index decreased 0.1% in the month of March. For the 12 months ending March, the index is up 2.3%. So very much in line with the Fed's expectations or their goal for inflation. The producer price index, a little bit more of an earlier number, so certainly there's been some change, but on April 11th, the Bureau of Labor Statistics reported that the producer price index decreased 0.4% in March. This is the first negative decline since a decline of 0.4% in October 2023. Now, on a year-over-year basis, the producer price index is still up 3.4%, but again, it is trending lower. The consumer price index. On April 10th, Bureau of Labor Statistics also reported that the consumer price index decreased 0.1% in March. This was after increasing 0.2% in February, and on a year-over-year basis, the index is up 2.4%. So of the three major inflation gauges, they all came in negative in March. We've seen the last 12 months come down to more acceptable levels. So that certainly fits with the narrative that inflation is coming down, and it's probably coming down because, number one, the Fed has kept rates higher. Those rates have subdued economic activity, and that's leading to an overall slower economy. On the jobs front, April jobs report. This was published May 2nd. The Bureau of Labor Statistics announced that 177,000 jobs were added in April. This was actually a little bit of a surprise to the upside. According to Investopedia, the U.S., based on their consensus, was expected to add 133,000 jobs. The unemployment rate is at 4.2%. So still healthy numbers there. And then last but not least, the Atlanta Fed often quote their GDP Now forecast model. As of May 1st, the Atlanta Fed is predicting second quarter GDP will increase at an annualized rate of 1.1%. Now, that is difficult to digest because there's no way for the Fed to predict how these imports are going to roll out of the economy. So if you told me sitting here today, the U.S. economy is like the Titanic, it doesn't move on a dime, but given the uncertainty, given the tariff situation, given the import situation, you could tell me second quarter GDP would be negative, would be zero, or would be plus 3%. And I would say, okay, all of those sound accurate. So I think we're really kind of in a wait and see. Biggest thing we're going to see right now is what does the Fed do over the next 2 days?
Absolutely. I don't think they're going to cut like now. I think they're still going to, hold off a little bit, just to once again get some confirmation on the numbers.
For those of you with variable debt like I have, fingers crossed they cut.
It would be good. I don't know if they will because just some of the rhetoric may make them hesitant.
I don't think
If
they
they're
want to show that they're being bullied into
correct. Had the bullying not happened, they probably would have. So it may be another month or so, before they do cut.
But we're closer to cuts than we are to, I think, a neutral position. Certainly, we're not seeing increases.
Yes, big picture right now. I mean, now it's all about earnings, and Alphabet came in, Google came in, better than expected. That kind of helped spark a rally in the last week or so. In the market, it is going to be all about earnings. It seems like some of the activity this month or last month has been a lot stronger than expected. You heard some theories on, with the pundits saying that potentially it's people, buying sooner, kind of pre-buying. Could be. I mean, definitely from an import standpoint, or people buying,
We're definitely
overseas products, people trying to get in before, make their buys before, even consumers, cars, foreign cars and so forth, trying to buy them before tariffs come, take a hold. So that activity, okay, maybe it's pulling some forward, but then again, does it really always pull it forward in that activity sparks business profits, which spark more spending, and does some of this get smoothed over versus, hey, we bought it now, we're not going to buy it later? Does the American consumer really think that way? I would argue they don't. So when the money's in their pocket, they spend it. So we could actually, kind of get through this whole thing without major economic dislocation is kind of what I'm starting to sense. Earnings are going to tell the whole story.
Yeah. And I think that's where we're at is we just, at this point, we just don't know.
And the earnings effects very well could be spread over several quarters, where some companies don't feel it until a year from now, some profit now. So it's going to be very erratic. And because our economy is so diversified and dynamic, um, I don't have big negative feelings. I just, think that volatility is still ahead of us. There's a lot of unknowns out there. We're starting to get into the, tax debates with the The big, the
Potential
big,
tax
the
cuts.
big bill coming out. We'll see what that actually looks like. There could be some give and take ultimately on that, and then come July when tariffs take effect again, you know, keep your seatbelts on.
Yeah. But
'Cause
that
it's gonna be a long, bumpy ride.
but that is the
Um,
point. I mean, we're not buying the market. We're not buying
ex-
indexes. We don't want to own everything. We are focused on individual companies and their outlook.
exactly. Speaking of the market, last week or last month, crazy month. I mean, at one point, we saw
Armageddon in the first of the month.
things were down 13, 15%. And by the end of the month, the S&P for the month was only down 0.76%. Had we
Buckle up.
hard to believe that 2 weeks ago, there was no way we're going to have a positive, close to a positive month. Well, 0.76 on the S&P for the month. Year to date, that takes the S&P down to, negative 5.31 year to date. And like I said, we were down in the teens at one point during this month. Dow Jones really got hit the hardest this month, and it was kind of a rally in the tech stocks the last couple of weeks, the last week or so, that kind of brought things back up. But the Dow still down 3.17%. The reality there is they are definitely more susceptible to tariffs and what's going on. So, that explains what's going on with the Dow. Year to date, the Dow is down 4.41. And then the NASDAQ actually eked out a positive, talking about volatility, actually turned out a positive month of 0.85%. But year to date, it's still down 9.65. So, a lot of volatility. We've made some comeback, but, all three indexes are still, still in the red. Still have a lot of work to do there. Small cap stocks, the Russell 2000 still down 2.38 for the month. Year to date, still down 11.93. International markets have been the safe haven so far this year. In April, the EAFE, which is developed world, up 4.17. So we've seen international work. Part of that is the weakening dollar does, add appreciation to international assets. Year to date, the EAFE is up 10.58. So any kind of international exposure, and we especially see this in 401k plans where that's where most of our clients have their international exposures, have held up really well. Emerging markets for the month up 1.04%. Year to date, still only up 3.47. I think that's the fact that they're lagging so much is just kind of reflective of potential weakness in the global economy. On the bond side of the equation, the Bloomberg aggregate bond index up 0.39 for the month. We did see rates come down a little bit. Year to date up 3.19%. So markets in general, a lot of volatility, but we've kind of gotten through it, and we'll see what this month has to hold. Our portfolios, growth with income portfolio for April down 1%. Year to date, we're actually plus 1.5%. Big gainers, Toyota up 8.5%. There's international stock.
Go figure.
Iron Mountain up 0.6. Nvidia, saw some gains there. Finally up up 3%. Laggards, Nike down 10%. Obviously, big importer. PepsiCo down 10% for the month. EOG down 12.5%. EOG is a natural gas producer. Obviously, we've seen softening in oil and gas prices, which should help inflation. Big gainers year to date. Gold is our big winner in here, up 23%. Raytheon's up 10%. Berkshire Hathaway up 17%. One note on Berkshire, obviously that's been a great hold for us long term. They had their annual meetings this weekend and officially did announce that Greg Abel is going to be taking over for Warren Buffett. Warren Buffett still involved, but obviously I think, longevity, age, it's time to make some things official. He'll do it till he dies, but
Yes, he will.
he is, kind of handing over the reins, not to really take effect until the end of the year. Laggards in the growth of income, Nike down 25% year to date, Microchip down 19% year to date, Disney down 18% year to date. Dividend yield, here, this is kind of where we get I think, the tariff exposure here. We have a lot of multinationals in this group, high dividend yielders. April down 5.5%. Year to date, we're down 5%. So that's, that portfolio is taking on the chin a little bit. Gainers in April, J&J was up 2%. Duke Energy up 0.8. This is as good as we get there. Laggards, Chevron down 19%. Eastman Chemical down 13%, enterprise products down 13. Year to date, big winners: AEP up 17.5, Amgen up 12%, J&J up 8. So we're getting, the healthcare stocks or the pharmaceuticals are doing pretty well. Year to date laggards, Target's down 31%, which we did step away from. Packaging Corp down 18%, US Bank down 16%. Packaging Corp is still sitting on a pretty big gain in there. That's been working pretty well for us long term. Appreciation with income, gainers for April down 2%. Just got into the positive, up 0.01 or flat. So, year to date, not a winner, not a loser. So that's good. Winners in April: Amphenol up 16.5%, Broadcom up 14, Eli Lilly up 11.6. April laggards: Schlumberger and Energy Transfer Partners down 12%. We did just exit Schlumberger today. Kinder Morgan down 8%. Year to date, Cigna's a big gainer in there. Lilly, Cigna up 23%, Eli Lilly up 16%, Pinnacle West up 12. Year to date laggards: Broadcom down 17, Energy Transfer Partners down 16. Price potential for the month down 0.3%, so kind of in line with the S&P this month. Year to date, we're still down 6%. Gainers in the month: Mercado Libre up 22%, Uber up 11, Celestica up 8 for the month. Laggards: Euronet Worldwide down 9, Global Life down 7, Meta down 8. Year-to-date gainers: McKesson's still a big winner, and they're up 18%. A lot of other gainers we've sold off. Year-to-date laggards: Dell's down 20, Nvidia's still down 16. Like I said, we did make up a little bit of ground last month, and Google down 16. And then in our SMID portfolio, our small caps, a lot of volatility here. April, we're down 3%. Year to date, we're still down 13.5. So small caps have definitely been all over the board. We did have some big winners in April. Natural Grocers up 22%. Radware up 10%. Farmers and Merchants Bank up 10%. Laggards: Aris Waters down 22%. Amerisafe down 12%. And then year to date, Natural Grocers are a big winner, up 27%, and PTC Pharmaceuticals up 10%. For the year that we're still holding on to, BLCO, we're down 36%. We did sell that. And the other thing we're holding is STRT. We're down about 20% in there. So, to be expected, small cap stocks are all over the board. I mean, I think we're holding up pretty well compared to the index. Little rally last couple of weeks. Earnings are going to tell the story.
Bruce is going to tell the story. And I think what is important in what we've seen here, we've had a lot of clients obviously calling, emailing in early April because of the volatility. And what I've tried to show people is, if you look at the Dow Jones over the last 100 years, survived the Great Depression, survived 2 world wars, survived Korean conflict, Vietnam, assassination of a president, resignation of a president, 9/11, COVID, the tech crash. We have these situations. You have to expect that every several years you're going to have some volatility, but good companies are always going to be there. The market's always going to be there. If you had sold out in the bottom because you thought everything was going to hell in a handbasket, you'd be hating yourself right now. So you got to stay in the market. You can make fine adjustments, but you can't go all in, all out. That's where the retail investor constantly gets
companies are going to adjust. That's the reality. Is companies have the ability to adjust. They'll find ways to keep their profits up. The landscape is changing. There's always uncertainty. It's definitely heightened now, but we will get through this. This, once again, like COVID, this is self-induced, and the reality is the economy isn't bad. Maybe slowing a little bit, but it's not falling off a cliff. The banking system is well capitalized, very solid, so we're not going into a financial crisis. And there's not a lot of areas that really are way overvalued. I mean, there's still definitely some overvaluation out there, but it's not excessive. A lot of that's gotten really out last year. So we're not in a horrible spot. a lot of these issues will get worked through, get reversed, or morph into a different look as to what's going on. But in general, we're things are not horrible, and fortunate fortunately we have we can get paid by being safe. If we have money in money markets are still paying 3 to 4%. Bonds are still offering decent returns where you can get 4 to 6% in bonds. Hey, versus 6 years ago, 5 years ago, you get zero.
Zero.
Yeah, so we can add more balance in the portfolios. That helps absorb the downside. Gold has been a big winner for us. Commodities are decent right now, except for oil and gas. But in general, it's gonna be a choppy ride. But I'll go back to what I've said in the past: is I still think we make money this year.
I do too. I agree with you. So, with that, thank you very much for the trust you've placed in Ellsworth Advisors. We'll talk to you again next month. If you have any questions about your portfolios, please feel free to reach out to us, and have a great day.
Thank you.